Good morning, everybody. It's 10 o'clock on Tuesday, time for our weekly webinar. Hope you all had a great weekend. I want to remind you that there will not be a webinar next Tuesday. I'll be on vacation for part of the week, and then I'll be out in Las Vegas with our friend Ed Slott for 3 days at the slot updates. So that's twice a year. These are events that we have to attend to be part of Ed's group and to be constantly on top of these important changes in the tax law and rules and regulations around IRA distribution planning. So I'll send you the recording for this week, and then you can look at some of the other recordings while I'm away if you're really missing me. So let's get going. So it is October 11th. If you're watching this on YouTube, I'm going to ask you to click the like and subscribe and notification button. Please remember that you are being recorded. There is a Q&A if you're live in the bottom of the screen. You can click on that, type in your questions, and I'll answer them before we're done. And today we're going to go over what we typically do. We'll have about 15 minutes worth of updates from the slot groups. We'll talk about some market updates and review some analyst reports, and then we'll go over our financial planning topic. So our topic today is stock, different types of stocks and dividends. I was going to end our investment fundamentals last week with our discussion about indexing and indices and what they are. We did a description of the S&P 500, the NASDAQ, the Russell 2000, and others, and how they're used. But as I was thinking about it over the weekend, I thought, we didn't really talk much about stock, and I kind of thought it's something that everybody knows, but this is general information. I want to give you the investment fundamentals, like basics of investing, and not everybody really understands what a stock is and what dividends are. So I thought it'd be good to talk about this this week. So remember, we have a special guest webinar on October 26th at 6:30 p.m. That's a Wednesday, and that's with Heather Schreiber, who's a Social Security expert. And I'm going to start putting in some information from Heather's newsletter periodically during this webinar, and I have just a little snippet to talk about today. Still working on our new website. That'll probably won't be up until the first, the beginning of next year, but that's still an ongoing process. Okay, just click your raise hand button for me if you can see me and hear me okay. Wonderful, thank you. All right, let's talk a little bit about headlines.
Unfortunately, we don't talk about this, but there's this massive war going on and still in Russia and Ukraine. And there's a missile strike again in Ukraine yesterday, which really had a terrible impact as it always does. But I just want to mention it so it's on the top of our mind. But and obviously it's a terrible thing, and it's going to continue to affect us all globally, and to a much greater effect those on the ground there. And we're saying that I've become more active in my Rotary Club again in Newtown. After I stopped on the school board in December, I kind of took a break for 6 months or so. It was almost like a hangover. I just needed to disengage. And just a few months ago, I got back involved with Rotary. Now I've been a Rotary member since the late 90s, but I've had different levels of activity. So I've been enjoying our weekly lunch meetings, and I'm hearing a lot from the local school. There's a lot of Ukrainian children being enrolled in the school because they're really basically refugees from the war. And one terrible story was, both mother and father were killed in the war, and the sister or aunt who was taking care of the children had enrolled the kids and are trying to get custody of them. So it hits home certainly, and it's a terrible thing. Anyway, so we've got some economic events this week. So the NFIB, let's see, that is the NFIB, National Federation of Independent Business. Yes, that's what that is. So the NFIB reports today their sentiment. So this is small business sentiment. So we get to hear, what small business owners are thinking about the economy. Friday, we get a preliminary look at how consumers are feeling when the University of Michigan releases its consumer sentiment for October. Of course, we have the consumer price index coming on Thursday. Everybody believes inflation is going to tick higher. So if it does tick lower, maybe we'll get some stability in the markets, or maybe it won't just be another red day like it's been so far this week. But last week it was a positive week in the end. I know it doesn't feel like it, but we'll talk a little bit about that. Big news in the inherited IRA area that came out on Friday. And it's regarding eligible designated beneficiaries and non-eligible designated beneficiaries. So just to give you some background, you might remember that the Secure Act required it basically nixed the stretch IRA for anyone other than eligible designated beneficiaries. But then it imposed this 10-year rule. All assets had to be depleted out of these inherited IRAs by the end of 10 years. But then the IRS came out and said, well, it looks like we're going to have to do RMDs in those 10 years as well for non-eligible designated beneficiary. Well, actually, for everybody. And then they reversed that. They came out with a letter that said, never mind that. And then they came out with regulations that reversed it again. So there was a big question, and we had a question from one of our viewers. She was asking about RMDs, and she was still under the impression that she did not have to take these RMDs. Her husband had inherited an IRA. He was not an eligible designated beneficiary, and the question was, did he have to take RMDs? And the answer is yes. But the IRS didn't come out with these proposed regulations until, I guess, February. So what about 2021 and what about 2022? 2022, it could argue that the regulations came out in February, so you could get this done, but 2021 is come and gone. So we thought that they were going to waive the penalty, the 50% penalty for missed 2021 RMDs. Surprisingly, they came out and they waived the penalty for both 2021 and 2022 RMDs within the 10-year period. Now, this doesn't apply. This is for inherited IRAs only. This doesn't apply for your own IRA. So let me share my screen so we can start going through the slot report. The elusive share screen button. Okay, so you'll see here, this is from Ian or Berger. So IRS waives 50% penalty for missed 2021 and 2022 RMDs within the 10-year period. Now, again, this is only for inherited IRAs. Can't say that enough. Don't get the impression that you don't have to take your regular RMDs this year. So Ian writes, last Friday, I'm right here, October 7th, the IRS waived the 50% penalty on missed 2021 and 2022 inherited retirement account RMDs for beneficiaries subject to the Secure Act 10-year payout period. Guidance was in IRS Notice 2022-53. The notice says the IRS will not impose a penalty for missed 2021 and 2022 RMDs within the 10-year period if the account owner died in 2020 or after his required beginning date with a beneficiary who is not an eligible designated beneficiary. So I'm just going to pause there, and I'm just going to remind you, I wrote down who are eligible designated beneficiaries because we talk about this a lot, and I think it's important to review it. There are 5 classes of eligible designated beneficiaries. They include surviving spouses, minor children of the account owner, disabled individuals, the chronically ill, or beneficiaries not more than 10 years younger than the IRA owner. So those people can still treat an inherited IRA as using the stretch IRA method. So over their life expectancy. If you don't meet one of those requirements, then you have to deplete the IRA, the inherited IRA, by the end of the 10th year after the year of death. But you also, the IRS tells us now, and this is different than what they told us a year ago, you must take required minimum distributions along the way. This notice is saying that the IRS, because they were kind of slow in that regulation, publishing that regulation, that they're not penalizing anybody for 2021 or 2022. I think I was right here. The required beginning date is April 1st of the year after the year the IRA owner turns 72. The IRS will also not impose a penalty for missed 2022 RMDs within the 10-year period by a beneficiary who is not an eligible designated beneficiary if the account owner died in 2021 or after his required beginning date. The IRS says that a penalty on missed RMDs within the 10-year term will not be imposed until the 2023 at the earliest. If a beneficiary already paid the penalty for a missed 2021 RMD, the beneficiary can request a refund from the IRS. Although the notice is not clear, it appears that since the penalty is waived, the missed RMDs don't have to be taken at all. So what they're saying is it's likely you don't have to go back and take your 2021. And if you haven't taken your 2022 yet, you likely don't, because there's no penalty for it if you don't take it. So that makes sense. And that, again, I have to say that is not for your regular RMD. That is for an RMD, required minimum distribution, on an inherited IRA. Different rules. And that's what they're saying here. It's important to note that notice does not affect lifetime RMDs. Inherited IRAs by eligible designated beneficiaries, or RMDs by beneficiaries who inherited before 2020. So they give a little bit of background. I'll read that to you again. I gave you a little bit before, but as background, the Secure Act imposed a 10-year payout rule for an individual beneficiary who is not an eligible designated beneficiary and who inherits after 2019. That rule requires that a non-eligible designated beneficiary empty the retirement account by the end of the 10th year following the year the account owner died. In February of 2022, the IRS issued proposed regulations that said that if the account owner died on or after his required beginning date, a non-eligible designated beneficiary would be subject to the 10-year rule and would be required to take annual RMDs during years 1 through 9 of the 10-year period. That interpretation surprised most commentators, who thought the 10-year rule would apply like the pre-Secure Act 5-year rule, which did not require annual RMDs. And I may have misspoken earlier on when I said that the 10-year rule the RMDs during the 10-year rule applied to everybody. It's only to non-eligible designated beneficiaries. So I didn't want to confuse that. In Notice 2002-53, the IRS said it received a number of comments indicating that it would be unfair to apply the annual RMD requirements when an account holder died in 2020. Since the non-eligible designated beneficiary would not have known that an RMD was required in 2021. Makes sense. But, the IRS doesn't always work in the lines of logic. The notice also gives relief to beneficiaries of an eligible designated beneficiary who died in 2020 or 2021 while taking annual RMDs. All right. So I hope that's helpful. I know a lot of people are breathing a sigh of relief. Here's the mailbag for today. Another question about RMDs and inherited IRAs. So this is a common one. It's very similar to a question we had last week. I actually had to check the dates. This came in after our webinar last week, but it's very, very similar. But this is a common question we get, especially when we're in situations like we are right now. It reads, I must take an RMD this year based on 12/31/2021 account values. So that's how RMDs work. They take a snapshot of your account the year prior, the year when you have to take your required minimum distribution, and you divide it by your factor, or now multiply it by the rate that's on the RMD table, and you can access that on the website, on our website, Attleboro Wealth Management, under the slot corner. You can scroll down and all of those tables are there for you. So in this case, this writer is answered. They're saying this is typical. I'm sure the account values are much higher than they are right now. So, this person could be down 20, 30%, who knows? And they have to take a required minimum distribution. This is typical, I'm sure. Is there any chance Congress will recognize this hardship and grant some relief similar to that granted several years ago when the virus pandemic began? And actually during the Great Recession, this happened too. There was kind of a stay on required minimum distributions because accounts were down. The answer, and who is this? This is Andy. The answer, Andy writes, is kind of there's not much bedside manner here, but many account owners subject to RMDs, he writes, have seen their account balances decline this year. As such, their RMDs are elevated versus current values. So they have to take out a higher level than they would if they calculated it based on the values today. However, it's highly doubtful Congress will take any action to reduce or waive RMDs. The previous waiver was predicated on a worldwide pandemic that killed millions. What we experience now is normal market ebbs and flows. Volatility is part of investing, bulls and bears, booms and recessions. Our suggestion is to bite the bullet, take the RMD, don't expect a bailout from Congress, and possibly consider reallocating your account to minimize future volatility. Oh, that's right, Andy. And if you follow the principles that we follow, asset allocation, account segmentation, and principal protection,
then this wouldn't be a concern to you, because you would have your cash on hand to handle your required minimum distributions. And certainly, even if you had your accounts invested in a way, they'd be more, to fund the first 3 years, let's, for example, of required minimum distribution, they'd be invested in such a way that it wouldn't cause you the pain and anxiety that it does this writer. So I go back to those 3 pillars of investing, asset allocation, principal protection, and account segmentation. That's a way to, handle issues like this. So here's the next question. I inherited 3 traditional IRAs from my mother who died in 2020. I withdrew all the money in one IRA at the end of 2020. I took a partial withdrawal in 2021 and withdrew the remaining money from the second IRA in 2022. Am I required to take an RMD from the third IRA in 2022, even though the amount I took from the second IRA in 2022 far exceeded the amount I would have been required to take from the third IRA in 2022? In other words, may an individual aggregate RMD amounts for inherited IRAs and withdraw the total from one IRA? Well, you all probably know the answer to this already. So what Diane here is saying is, like, there's a certain amount, let's say it's $20,000 that she has to take for 2022. She already took it from one inherited IRA. She has 3. Does that mean she's got to take an amount out of, the third IRA also in 2022? And you probably know that you can aggregate your I'm down here. You can aggregate your IRAs, included inherited IRAs, for RMD purposes, not your retirement accounts, not your 401ks, 403bs. They cannot be aggregated, but IRAs, including inherited IRAs, can be. So you don't have to count each individual. You've got to count them for your calculation of your RMD, but you don't have to withdraw from each individual IRA. So Sarah writes, or Andy writes, excuse me. Yes, inherited IRAs from the same decedent can be aggregated for RMD purposes. Oh, that's a good point. From the same decedent. So if you have an inherited IRA from your mother and an inherited IRA from your father, they have to be treated separately. Since all 3 of your inherited IRAs came from your mother, you can calculate the RMD on each and subsequently withdraw the total from any combination of the inherited IRAs. Inherited IRAs from different decedents cannot be aggregated. Yes, I'm glad she clarified that, or he clarified that. All right, I hope that was helpful. I'm going to stop my share and I'm going to move on. Big news regarding inherited IRAs this week. So I have a little excerpt here from Heather Schreiber's Social Security newsletter. And this is a question I've received from people, so I thought it would be good to discuss it. So there's a lot of discussion about big COLA numbers, cost of living allowance increases for Social Security this year. And people say, well, do I have to claim by January or December to get my COLA increase? So Heather writes, should the annual COLA be a factor in Social Security claiming decisions? And she writes, judging by the numbers of calls and emails that I've received, seniors and their advisors have many questions as to how this inflation-caused COLA increase will play out in the real world. Common inquiries go something like this. Do I need to claim my benefit before January to capture the 2023 COLA? We've covered this before, most recently in the August issue of the newsletter, but it's worth repeating in one word: no. COLA is when declared or applied to a worker's benefit after initial eligibility, age 62. So you get adjusted up, regardless of whether the income benefit is collected or not. The COLA is effective each December with the first higher monthly payment, income benefit, paid to recipients to the following January. So you don't have to time your claiming strategy based on the COLA. It's going to be adjusted. So thank you, Heather. All right, let's talk a little bit about the markets. So the markets were up really across the board. Well, the stock markets were up across the board. The bond markets were kind of mixed, but down. The most common bond holdings being the Barclays aggregate bond, as I've told you, was down about 0.25%. Even the 1 to 3 year bond was down slightly, 0.07. The most common area of bond holdings, the aggregate bond that's reflected by the aggregate bond index, is now down almost 15%. So I'll just say again that sometimes people save money, and I'm air quoting for you folks who are just listening to this. Safe money is not too safe right now. The Dow Jones Industrial Average was up 2.03. You all know what the Dow Jones Industrial Average is. You all know what the S&P 500 is now, and that was up 1.56%. You all know what the NASDAQ is, and that was up 0.75. The Dow Jones Industrial Average is still down 18% for the year. The S&P 500 is down almost 23%, and the NASDAQ is down 31.5%. Wow. Wow. Treasury rates were up. The 6-month Treasury went from 3.90 to 4.07. The 2-year Treasury went from 4.28 to 4.31, and the 10-year Treasury went from 3.83 to 3.88. And you heard me right. You can get more interest for a 2-year government bond than you can a 10-year government bond. And that is what we call an inverted yield curve. And that is a precursor or a telltale sign of a recession. BlackRock writes, the new regime of greater economic and market volatility is playing out. We talked about this last week, the week before. You know, I follow BlackRock closely. I respect their analyses quite a bit. Central banks' singular focus on inflation deepens our conviction they will over-tighten policy in the near term and cause economic damage that markets are underappreciating. So they're saying that the central banks around the world are going to continue to tighten and really choke down economic growth. And they're saying there's going to be damage that the markets are not quite seeing yet. Now, that's surprising when you see all of the downward movement we've had, but it could get worse. We keep portfolio risk low as recessions loom and launch euro-denominated investment views. So that's BlackRock. Thank you, BlackRock. Okay. All right, let's jump in. I don't think I have any other analyst reports that are really saying anything unusual or anything helpful today. So let's jump into our financial planning. So stand by while I get myself together. So today we're going to talk about, here's our financial planning topic. So now we're going to divide the video. You're going to have the full length video to read from or watch. And then we also just had the financial planning topic. So if you're joining us just for this topic on YouTube, please remember to hit the subscribe, like, and notification button. But today we're going to I'm pretty sure this is the last of our investment fundamentals, and we're going to talk about stock, different types, and dividends. So there are 3 general types of stock. So stock is equity owned in a company, publicly traded company, typically. Yes, you can have stock in private companies, but we're talking about public common stock today. It's equity in a company. That's why it's referred to, you'll hear us talk about it as equities. And some of these investment folks often refer to them as equities. So I'll read you a definition again from Investopedia. You know, I like this website for you folks, but a common stock is a security that represents ownership in a corporation. If you have just one share of whatever stock you want to use, for example, then you have a piece of ownership in that company. Holders of common stock elect the board of directors and vote on corporate policies. The form of equity ownership typically yields higher rates of return long-term, this common stock form. If you own, so what they're saying is that other than some of these other types of shares, particularly preferred stock, if you have common stock, it typically has a better return or growth potential over time. You could, of course, lose every dollar you invest in any company in common stock. Even if that company doesn't necessarily go out of business, right? So GM went bankrupt during the Great Recession and common stockholders received zero, right? They lost all their money, even though you can still buy a GM car today. This form of equity ownership, okay. However, in the event of liquidation, there's a really good example. In the event of liquidation, common stock shareholders have rights to accompany assets only after bondholders, right? So GM bondholders got I think it was about 10 cents on the dollar. Preferred shareholders, we're going to talk about preferred shareholders or preferred stock, and other debt holders are paid in full. So bondholders, preferred stockholders, and other debt holders have to be paid before common stock holders are paid. So if you're an owner in the company, you're in
basically last place. Common stock is reported in the stockholders' equity section of a company's balance sheet. Common stock is a security. So as a recap of common stock is a security that represents ownership in a corporation. In a liquidation, common stockholders receive whatever assets remain after creditors, bondholders, and preferred stockholders are paid. So important to know those differences. Now, we talked about preferred stock. So what is preferred stock? So let's check off common stock. So now what is preferred stock? Preferred stock is a type of equity, right? So same thing, you have equity in the company that represents ownership of a company and the right to claim income from the company's operations. You don't have that right in the common stock. You can be paid dividends, but you don't have that right. Preferred stockholders have a higher claim on distributions, dividends and such than common stockholders. Preferred stockholders usually have no or limited voting rights in corporate governance. Remember, the common stock, you elect the board of directors. Typically, it depends on the type of stock that you have. There can be different share classes that don't have voting rights and they're still common stock, but just generally. So, but preferred stockholders, we're talking about preferred stockholders here, they have no voting rights or limited voting rights in corporate governance. So it can be no or limited depending on how the chart is written. In the event of a liquidation, preferred stockholders' claim on assets is greater than that of common stockholders, but less than bondholders. So in the hierarchy, you've got company A, and company A liquidates. So the first people to get paid are bondholders. The second are preferred stockholders, preferred. And the last are common stockholders. So you could be a shareholder in a big company, and if that company goes bankrupt or just completely goes out of business, you're the third in line. So the reason that you typically have more growth potential here is because you're taking more risk. Theoretically, bonds have the least amount of risk. Preferreds are, it's tiered kind of the same way, least amount. With bonds, preferreds have, the next level of risk, and then common has the most. Preferred stock has characteristics of both bond and common stock, which enhances its appeal to certain investors. So obviously, these are not recommendations to buy any of these. It's just an overview of how different types of stock in a company work. Preferred stock typically do not share in the price appreciation or depreciation to the same degree as common stock. The inherent value of preferred stock is the ongoing cash proceeds investors receive. So they are valued a little bit differently. So common stock is really the future earnings of the company. That's what the value is based on. It can also be based on the dividends, but most of common stock value comes from what we think it's going to be worth 12 months, 3 years, 5 years from now. Preferred stock is really somewhat, because you don't have as much appreciation, but it's the collective value of the future income payments. All right. Now, what about restricted stock? Not a lot of people are involved in restricted. So we talked about preferred. Not a lot of people are involved in restricted stock, but some people are. So I thought it'd be worth mentioning it because someone would probably put up a question. Well, what about restricted stock? And that's good. Restricted stock refers to unregistered shares of ownership in a corporation that are issued to corporate affiliates such as executives and directors. Restricted stock is non-transferable. So if I'm a restricted stockholder, I can't sell it to somebody else. It must be traded in compliance with special SEC, Securities Exchange Commission regulations. The restrictions are intended to deter premature selling that might adversely affect the company. Restricted stock typically becomes available for sale under a graded vesting schedule. So a vesting schedule is you might receive this. You might receive 100,000 shares of ABC company, but you can't sell any of that until it vests, which means you might. So what I say, 1,000 shares, 100,000 shares, whatever I said. So a portion of it, let's say 25% of it becomes available to sell after year 1. And then 25% of it becomes available to sell after year 2, and so on. So that's a vesting schedule. Vesting schedules can be very different
then they tend to last several years. Restricted stock is also referred to as letter stock and Section 1244 stock. All right, so that is restricted stock. Now let's talk about dividends. A lot of focus on dividends. I've talked a lot about dividends this year. Many of the things that we're implementing in strategies pay higher dividends because while we have this risk of falling markets, I want positions to some degree in our portfolios that are gonna help pay higher dividends. So at least we're getting some return, right, and cash flow while we're waiting. So there are different types of dividends. So let's talk about, okay, we went through common stock, preferred stock, restricted stock. Now let's talk about dividends. Well, the first we're going to talk about is qualified dividends. So some people talk about qualified and non-qualified. It's actually qualified at ordinary. So let's talk about qualified dividends first. Each different one has a different tax implication. That's really what drives it. So I'm going to share with you and why these are so important. So I'm going to pull down my website. I'm going to tell you where you can grab this information. So again, here's where you would land. Go to attleborowealth.com. You land on the home page. Raise your hand for me if you can see my website. Thank you. Hey, Michael, good to see you. All right, then you go to Slot Corner. And as you scroll down, I'm going to take you to this very familiar 2022 tax planning. So I want you to focus on right now this block up here. Taxable income brackets for 2022 long-term capital gains and qualified dividends tax. So you'll see here that if you're married filing jointly, you can pay 0% on dividends or capital gains. And that's all the way up to a modified adjusted gross income of $83,350. And then of course, 15% is where most people pay capital gains or dividend rates. And that goes from $83,351, of course, to $517,000. Now, once you cross over $200,000 for a single filer, I'm right here, or $250,000 for a joint filer, we have to add on the 3.8% Medicare surtax that came from Obamacare or the Affordable Care Act. So that added on an additional tax on the dividends for anybody making more than $250,000 as a joint filer, or $200,000 of modified adjusted gross income. So this could be 18.8 and this could be 23.8, but still less than the ordinary income rates that we see over here, right? The ordinary income rates or marginal tax rates on the left here. For that same 83,000, if you're paying, even if you're at 18.8, that's still less than the 22% marginal rate here. And of course, if you're at 517, you're all the way up in the 32 and then into the 35% bracket. So you can see where qualified dividends can be better for you from a tax point of view. So the big difference and why you got to pay attention to the type of dividends that you have are, of course, the taxation of those dividends. And of course, capital gains, but we're not talking about capital gains today. So let's see, qualified dividends are listed in box 1B on IRS form 1099 DIV, 1099 DIV. And that's a tax form, of course, sent to anybody who gets distributions. Now, sometimes you can't control these. We certainly can't control dividends in a mutual fund. And I guess you could control them in a common stock if you bought them, if you sold your position prior to what's called the ex-dividend date. But capital gains, can cause a lot of problems if you're not expecting it, not planning for it. So let's move this back up here, out of our way. To qualify for the qualified dividends of 0, 15, or 20 plus the potential surcharge, they must meet certain requirements as outlined by the IRS. So the dividend must have been paid by a U.S. company or a qualifying foreign company. The dividends are not listed with the IRS as those that do not qualify. So there's a listing, and the required dividend holding period must be met. So dividends that do not qualify right off the bat, we know are anything that comes out of REITs or real estate investment trusts. So they tend to pay some higher dividends at some time. So you've got to adjust that value based on it paying ordinary income. So what happens what happens when I may not have explained this clearly, but what happens if you don't qualify for those preferred rates, right? The 0, 15, 20 plus the surchecks. What happens is those dividends flow right into your marginal tax brackets. Remember our graduated cylinder, and you've got those, 10, 12, 22, 24, 32, 35, and 37. These are your marginal tax rates. So any dividend that you have, again, if you get $10,000 in dividend qualified dividends, it follows that smaller schedule, 0, 15, 20 plus 3.8 potential surcharge. But if these are for qualified dividends. These are for ordinary dividends. So obviously this is better from a tax point of view, that the money that, your dividends fall into here, because you're likely to pay lower tax. If they fall into here, depending on where you land, you could certainly pay higher amounts on tax on those same dividends. So it's important to know whether your dividends are qualified or ordinary. Master limited partnerships don't qualify. Those on employee stock options, dividends paid from money market accounts don't qualify. Deposit and savings banks, credit unions, or other financial institutions do not qualify and should be reported as interest. Special one-time dividends also are unqualified. Lastly, qualified dividends must come from shares that are not associated with hedging, such as those used for short sales, puts, and call options. And I explained that if they're not qualified, basically they're subject to ordinary income tax. They're ordinary dividends. The holding period that's referred to gets a little complicated. So I'll just read. It's not too bad. I'll read this to you. The IRS requires investors to hold shares for a minimum, so this is common stock holding, for a minimum period time to benefit from the lower tax rate on qualified dividends. Common stock investors must hold the shares for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date. So the ex-dividend date is when the company declares the dividend date, and then it's a scheduled period of time before that, or the date after the dividend has been paid out and after which any new buyers would then be eligible to receive future dividends. For preferred stock, the holding period is more than 90 days during a 181-day period that starts 90 days before the ex-dividend date. So different rules for common stock and preferred stock. And I have to tell you, I knew this going into my licensing and other requirements, probably my CFP exam too. I had to look this up. I can't remember these holding periods. So I don't expect you to. I'm just giving them to you as a reference. For mutual funds, it's different. The holding period requirement is somewhat different. In this case, a mutual fund must have been held unhedged for at least 61 days out of the 121-day period, which began at least 60 days before the ex-dividend date of the security. Investors must have held the applicable share of the mutual fund for the same period as well. So the holding period can be challenging. If you're counting on the dividends, just make sure that you're holding the period or holding the position so that you qualify and can receive those dividends. And then you're going to want to know whether they are qualified or ordinary, so you know when they're going to be taxed or how they're going to be taxed. So your next question may be, well, how do I know? Well, you have to really check with your custodian. So we pull up we custody with now TD Ameritrade and Schwab. We're completely done with Fidelity now. So it's TD Ameritrade and Schwab, and we check the positions. Of course, any of the ones I told you that are not qualified, REITs, real estate investment trust, master limited partnerships, also business development companies. They don't qualify. They're ordinary dividends. So you wouldn't necessarily know without asking your advisor or going direct to the custodian. Okay, well, we talked about a lot today. We had some good headline updates. We went over some timely information from the Slott Group. We talked about Social Security a bit and the markets, and then we talked about, during our financial planning topic, different types of stocks and dividends. So there is a question. Let's just see. So Keith asks, I thought you had to hold a stock for 1 year before dividends are qualified. You're thinking about capital gains, Keith. You have to hold, typically, you have to hold a stock for at least 1 year before your any gains you have qualify as long-term capital gains, which again, long-term capital gains, if they're qualified, fall into the same category, this smaller scale, 0, 15, and 20, plus the 3.8 Obamacare surcharge or Affordable Care Act surcharge. So that is capital gains greater than 1 year. If not, they fall right into your ordinary income and are treated as ordinary income. And they fall right into your marginal tax bracket wherever you happen to land. Good question. Of course, you're welcome. All right, everybody, we will not see you next week. There is no webinar next week. We will see you on the week of the 25th. So we're going to have the weekly webinar on the 25th, and then we're going to have Heather Schreiber on the 26th at 6:30. So I hope you can join us for both. Have a great week, and give us a call with any questions. Take care.